Welcome to Investify, where finance meets foresight. Today, we're diving deep into the world of market predictions and investment strategies with a focus on one of the most renowned figures in the field, Jeremy Grantham. Imagine a world where the stock market takes a nosedive, sending shockwaves through your investments. This isn't just a hypothetical scenario. It's a prediction from a man who has eerily been right before. Stick around as we unveil the details of this chilling forecast and explore strategies to safeguard your portfolio. Jeremy Grantham, the co-founder of GMO and a maestro in market predictions, recently made headlines on Bloomberg's Marin Talks Money podcast. Known for his sharp acumen, Grantham has rung the alarm bells with a dire warning: a potential crash in the S&P 500. But how severe could this be? According to Grantham, we might see the SP plummet to about 3,000 points, marking a near 30% decline from its current standings. And if the conditions worsen, brace yourselves for what he describes as a worst-case scenario: a staggering fall to 2,000 points, a jaw-dropping 50% decline. Now, why should we pay attention to Grantham's predictions? The answer lies in his track record. He's not just any market analyst. He's the one who accurately called the dot-com bust and the 2008 financial crisis. His forecasts aren't mere speculation. They're based on years of experience and deep market understanding. Grantham's current view paints a picture of an overvalued market, heavily reliant on a group he refers to as the Magnificent 7 Inches. These are primarily tech giants, driving much of the S&P 500's value. But what happens when these overvalued stocks start to correct? That's the crux of Grantham's concern. Turning our focus to Grantham's investment strategy, let's delve into his moves in the third quarter of 2023, as revealed by 13F filings. These filings provide a window into the minds of major investors, showing us where they're placing their bets. In Q3 of 2023, Grantham made significant moves by increasing his stakes in 3 key stocks by over 10% compared to the second quarter. This decision indicates a strategic shift, highlighting his confidence in these investments amidst a turbulent market forecast. If you're finding this insight into Grantham's strategies enlightening, remember to hit that subscribe button. We bring you the latest and most profound investment insights right here on Investify. As we navigate these predictions and strategies, it's crucial to understand the implications for your investments. What do these moves mean for the average investor? Stay tuned as we analyze each of these key stocks in detail, unraveling the potential behind Grantham's choices. Let's take a closer look at the specifics of Grantham's investments, starting with United Health Group Incorporated, or UNH. This healthcare giant has seen a significant uptick in Grantham's attention, with a notable increase in stakes in the latter half of 2023. But why UNH? The answer lies in its performance and financials. From 2013 to 2023, UNH has shown a remarkable trajectory. Its revenue surged from $122 billion in 2013 to an impressive $359 billion in 2023. That's a compound annual growth rate, CAGR, of over 11%. It's not just about the numbers, it's about consistent growth in both revenue and net income, a sign of a company that knows how to grow and sustain itself. In terms of valuation, UNH is trading at 1.4 times its sales and 24 times its net income. These figures are crucial for investors as they help gauge the stock's relative value. A low price-to-sales ratio might suggest undervaluation, making it an attractive buy. On the other hand, the price-to-earnings ratio offers insight into how much investors are willing to pay for each dollar of earnings, a vital indicator of market sentiment. Next on Grantham's list is Johnson & Johnson, or J&J. A household name, J&J has been a long-term holding for Grantham, stretching back to 2005. This longevity speaks volumes about the company's stability and Grantham's confidence in it. But what makes J&J a robust pick in Grantham's portfolio? Financial strength is a key factor. J&J boasts a high return on capital employed, a metric that measures how effectively a company generates profits from its capital. Additionally, the company projects a stable earnings per share growth of 4.3% annually from 2023 to 2027. This steady growth is a green flag for any investor looking for sustainable returns. J&J also offers a dividend yield of 3.2%, with a 47% EPS payout ratio. Dividends are a critical aspect for many investors, especially those seeking regular income from their investments. A yield of 3.2% is substantial, especially in a low interest rate environment. The valuation of J&J also merits attention. As of November 2019, 2023, its fair value per share stands at $182, while the current price hovers around $152. This gap indicates potential undervaluation, suggesting room for growth and making it an attractive proposition for investors looking for value buys. Now, let's turn our spotlight to another key player in Grantham's portfolio, Merck Co, Inc., commonly known as MRK. This pharmaceutical giant occupies a significant 1.96% of Grantham's portfolio, reflecting a deep-seated confidence in its potential. But what's driving this confidence? Let's break it down. Over the last 5 years, MRK has seen an impressive 43% increase in its stock value, translating to an average annual growth of 7.4%. This steady ascent is a testament to MRK's resilience and strategic business model, especially in a sector as volatile as pharmaceuticals. It's not just about short-term gains, it's the consistency of growth that makes MRK a standout. A crucial factor contributing to MRK's appeal is its dividend growth. In the last 5 years, MRK's dividend per share has climbed from 48 cents to 73 cents. This 8.7% annual growth in dividends is a significant indicator for investors, especially those prioritizing income alongside capital appreciation. It shows MRK's commitment to returning value to its shareholders, an essential quality in a long-term investment. The company's performance in the third quarter of 2023 further cements its status. MRK reported a robust 7% year-over-year sales growth, buoyed by a staggering $6.3 billion revenue from one of its key drugs. This impressive figure highlights MRK's ability to generate substantial revenue streams, a critical factor in sustaining growth and shareholder value. From a valuation perspective, MRK is currently trading at a forward price-to-earnings ratio of 12.1 times. This is significant because it provides a glimpse into what the market is willing to pay today for a share of MRK's future earnings. Moreover, MRK is expected to see an annual EPS growth rate of 14.4% over the next 5 years. This projection is a strong indicator of the company's potential for continued financial success and its ability to outperform the broader market. As we wrap up our deep dive into Jeremy Grantham's market insights and investment strategies, let's revisit and consolidate the key takeaways. Grantham's warnings about a significant market downturn carry weight, especially given his track record of accurately predicting major economic shifts. These warnings are not just alarm bells, but a call to action for savvy investors. The focal point of Grantham's current investment strategy is particularly noteworthy. He's placing a strong emphasis on the health sector and undervalued stocks with substantial growth potential. This approach highlights a strategic shift towards industries and companies that not only offer stability in turbulent times, but also promise long-term growth. The health sector, as exemplified by Grantham's investments in UNH, J&J, and MRK, stands out as a resilient and potentially lucrative field. Grantham's diversified portfolio is a masterclass in mitigating risks while capitalizing on growth opportunities. In a market teeming with uncertainties, this diversification is a critical strategy for balancing potential risks and rewards. It's about not putting all your eggs in one basket, but rather spreading them across baskets that have the strongest weave. Investing, much like any strategic endeavor, requires foresight, adaptability, and an acute understanding of the market dynamics. As we've seen through Grantham's approach, being well-informed and strategically diversified can make a significant difference in navigating the stock market's ebbs and flows. If you found this analysis helpful and are keen on staying ahead in the investment game, don't forget to like this video and subscribe to Investify for more insightful content. Our journey doesn't end here. It's just the beginning. With each video, We aim to empower you with knowledge and insights to make informed investment decisions. Thank you for watching Investify, where we bring the world of finance to your doorstep. Keep an eye on those markets, stay informed, and most importantly, stay invested. Until next time, keep building your financial future with Investify.